All right. I just want to make sure that even though it's a very short trading period for the project, at least you're able to do something, get something done, and mainly to understand. Okay, so you can read this. It's very self-explanatory. It's very pretty clear. There should not be any problem. But I'm just you can read this. We've already discussed all this. All right. So what you have to do is you have to look at your balance sheet exposures. All right. And if you're this, so everything is explained here. And I'll just explain the broad framework of the. You already know how it has to be done. All the most of this golden rule of hedging also has been explained to you. You'll have to apply it. Okay. What is this? There's a double star which I have not filled in. Zero and the amount of initial underlying position, and the amount can be negative. Okay, yeah, I know what this is to be. This is not affecting your project, but this is for your learning. Okay, initial underlying position can be, it should be, not just can be. When you're running a real life program, what this means is, I'm gonna write it out. Before I write it down, I will tell you what I'm talking about. Okay, which is that what I'm going to write down now is the observation that I'm going to make, the little footnote, which is that in real life, when you're talking about initial underlying position in the context of the golden rule of hedging, the initial underlying position is to be modified by fresh updates. The way it works in the real world is that if you're managing, let's say for Rio Tinto, you're the risk manager, corporate treasury risk manager for Rio Tinto. In that case, what happens is you have to have direct hotline essentially to the production team and as well as to the sales team to see what is the economic exposure balance sheet. So when we have initial, you may start the hedging period with 2.5K troy ounces of gold. All right, but of course this number is changing rapidly, and so you have to keep on updating this figure. So maybe after 3 weeks. The production team will call you and say that, okay, unsold inventory is going up to 19.5K tons, in which case your figure becomes 19.5K. So that initial figure is to be updated, and so now the limits will be between 0 and 19.5K. That's all I'm trying to say. It will not be between 0 and the 2.5K. All right. So whatever is the actual underlying position at a point of actual economic exposure at a point of time. So let's clarify this. Okay. Just to make this clear. Okay. So this is what I'm writing now. The amount of initial underlying position. This will not apply for your project. In your project, you're going to just start with this and end with this. Okay. So because we want to keep it simple and make sure you understand the basic procedure and your basic thinking, and it doesn't affect your basic learning from the project. So to avoid overcomplicating it, this will not change in the course of your project. But in this case, in the real world, you have to understand how it works. Okay, so initial underlying position in real life must be always. Actually, this should be called the latest underlying position, okay? Or this should actually be renamed as initial stroke current to give this sense. The English is not 100% perfect even now, but we can understand what we mean. All right, I'll just go on mute. Yeah, going back to sound. Okay, the hedging, but you understand what was going on because I was writing. So this. Right. So the hedging team must remain in touch with the sales and production teams um, for which keeps changing. So unhedged economic exposure, which keeps changing because of business activity, because sales are going on, production is going on. So new stuff is coming out of the ground, and stuff is already being sold. Whatever is there in finished goods inventory is being sold. So hedging team must remain in touch with sales and production teams for uh, latest figures. Okay, so this is a dynamic exercise. It is not kind of static like it will be in your project because we are trying to simplify the project. So it's just a note here so that you understand the full context here. This is basically what it is. Okay, so it's very simple. Now I'll explain to you briefly about how here there's a note on hedging for speculators. You can read this on your own later. It's not really it's not correct. Okay, this is already written in your options a little bit. Okay, so risk management project brief. This is fine. This is a bit repetitive actually, but you can see all this here. I'll just briefly tell you what is going to happen here. Okay, so all this was already being discussed with you. So what will happen is how you're going to be evaluated is that if you think, let's make this 85%. Okay. So before we go on to swaps, I want to just make sure you understand the whole project, how it's going to work, even though it's a very short project. Okay, so when we start the project, I will freeze the day on which we start. I'll take the previous night's New York closing figures for these KRFs, okay? And that will, of course, have so these prices will change, okay? And they will reflect the prices on whatever that date is, that New York closing date, the day before the start of your project. And then, of course, that will have an impact on the market values and the net worth. Okay, so then we'll have a starting net worth, which will be the same as this, all right? And then, of course, we will declare the start of the project, and then the project will run for whatever, maybe a couple of weeks or something. At the end of the project, of course, again, I will take the same values here. Okay, so I will take I will notice what are the values of what are the price figures for each of these, which will obviously be most likely be different from what was prevailing at the beginning. So I'll plug in fresh values at the end of the project. So New York closing for the last date of the trading in the project. And so this is all meant to reflect how it will work in the real world. So I will update the fresh values, and then I will see what happens to the net worth. Okay. So there is a starting reference, which we started with, which is the beginning of the project. And then you have a new net worth, which as you can see here, there is a small change because these prices are slightly different. And there is a slight adverse impact. Okay, so what that means is, so that difference between the starting net worth and the ending net worth is the P&L. Okay, so in this case, it'll be the underlying position P&L, right? So it'll be the underlying position P&L, which as you can see is, if you make this even smaller, you can see everything, I guess. Not even then you can't see it. Yeah, well. So the yeah, you can see now this is it's actually taken from the starting figure, and then it is G13, which is here. Yeah, G13 is here, and so this is basically the underlying position P&L is the starting reference P&L versus minus the this ending price. So remember, this is the exit price and this is the entry price. So this general P&L formula applies. So at the end of the period, at the end of the hedging period, we are going to, the accountants are going to look at what is your performance, and they'll say that, okay, the closing, the exit price, kind of like the exit price minus the entry price, okay, which is what you have here, this minus the entry price, which is the starting balance sheet. And that's your underlying position P&L. But remember that your total P&L is a function of hedge P&L plus underlying position P&L, all right? So in this case, what might happen is you might have made a hedge P&L. Your hedge P&L is basically nothing but your IBTWS P&L, because you're using that, and that P&L is going to be calculated by, I mean, although Ketan and Vipul will get fresh accounts with $1 million, and some of you might have more than $1 million at the moment, and some might have less, but doesn't matter. I'm going to calculate everybody's hedge P&L as ending minus starting, okay, for this particular project only. So we will look at those, and you'll have to submit the statements, the financial the account statements and all that to verify all the figures that you declare in your spreadsheet. So whatever, let's say Vipul's hedge P&L is $245,000. So in this case, Vipul's net P&L is going to be, as you can see, hedge P&L, okay, plus the underlying position P&L. In this case, the underlying position P&L is negative, but it's not necessary for it to be always negative. You could have a situation where this is positive and this is positive, or this is negative, this is positive, or this is positive, this is negative, all kinds of possibilities, okay? So this is what you deliver by your hedging expertise, by trading selectively on your account, by monitoring each of these. So if you're here, for instance, you're long dollar yen, and if you feel that dollar yen is actually, your exposure, underlying exposure here is actually long dollar yen. So if you feel that the dollar yen is going to keep on rising, then why would you hedge it? Okay, you would just let it rise. You would monitor it, but you would not hedge. But you feel if it's going to feel that any point of time it's going to decline, then you would hedge it, and then you would capture the profit. You would have locked in your, your underlying position. Realization of the underlying position would be at a high level for the dollar yen rate, and so on and so on. By using your skill, and therefore that's why it's always, everything is down to market forecasting, taking a view on the market and being right about it. And so that this is the total figure, so that you can see the total figure for Vipul's P&L will be this, okay? So in this manner, I will calculate everybody's P&L. And so let's say if Ketan has made 120,000 and Vipul has made 160,000, and these are the only two people in the course, then I will rank Vipul as, I will give him some rank. Okay, I'll give him some percentage figure, okay, and then I'll give some low figure for Ketan. And let's say in between there's somebody else, let's say Srishti is in between. And so in this case, then Srishti will get marks. I'll set something for Ketan and something for Vipul. And then Srishti will get the prorated percentage for the project based on the distance of her P&L between these two, okay? This is how it will be calculated. This is how it's been done for everybody in all the projects. So I try to keep it objective. I don't have any kind of written submission. And that's why you may feel, some of you may feel that, and it's understandable for you to feel that, but you should understand why I have made this kind of objective grading, because then there's no subjectivity. That is also a benefit for you, can be a benefit. That, I'm not giving you some write-up and all that where you write about what you did and what was your experience and all this kind of, that becomes very subjective, because to grade that kind of write-up is much more subjective. So I always prefer objectivity, because I feel that objectivity is very closely related to fairness. And I'm very concerned with being fair. Actually, fairness is the most important thing. I don't mind if I cut off everybody's hands. As long as I feel that it's fair, I have no problem with it. So fairness is the most important thing. So therefore, I like to look at objective measures which are very fair. Okay, so you should understand this also as in your own life, that if you have an objective measures are much more fair to people. So anyway, that's why this multiple choice machine graded entrance exams are much better than subjective essay type exams. Although there are certain things that can't be captured by multiple choice, but it's still fair. So anyway, so this is how it's going to be done. Any questions, anybody at this stage, as to how the project is going to work? So essentially your situation is that you're helpless as far as the underlying position is concerned. You know the stuff is moving around, the prices are moving around, but you can't touch any of the underlying positions. So what you can do is that if you feel it's going to go against you, you will hedge. That's all you can do. Okay, so this is how you manage it, and this is how you offset the loss in the underlying position P&L by your clever trading on the hedge P&L. Okay, so this is how it works. So if you feel at any point of time that anything you have, anything in which you have a position, an underlying position, then you will hedge and you have flexibility. And I've allowed you to trade dynamically in this project. So you can actually, it's a dynamic hedging program. So you can hedge, you can unhedge, you can hedge again. You can hedge 100% if you want. If you can hedge 25%, you can hedge 15%. It's all up to you. So this is where you show your creativity and your uniqueness, that you can do different things. Okay, some people can do different one thing. One person does one thing, another person does something else. Okay, so in this case, for instance, if you feel, I think we have already done. Okay, CL is not going to give us what we need. Okay, CL will give us corporate Colgate Palmolive, but let's look at US oil. So I think this is fine. We don't need this illustration actually, because everybody understands. Okay, so as you can see, oil prices are going up. If you feel that this is going to come down, you will hedge it. If you think it's going to collapse dramatically, then you will hedge 100% right now. Okay, if you feel there's a little bit more upside, you will. So accordingly, you will manage. We have discussed this many times. We don't need to go through that. All right. So, any questions at this stage about how the project will be graded and what you have to do? All right. So no questions. So we are cool. You guys can go ahead. Okay. And I'll now move on to the discussion of swaps. Okay. So we go back to swaps now. Here, what we are trying to do is, because we have swaps as part of your case, the objective of this case is actually to, the objective of the case is to try and cover these concepts in the context of this case. Therefore, you read the technical note. So it's a slightly different kind of structure from what you guys are used to, that you have the technical note. This is a very big technical note. And actually, the note on the swaps is also a technical note. But we are coming to it later because I wanted to cover the first one first, okay? And there are also other technical notes on foreign exchange swaps and Eurodollar futures, which we are probably not going to have time to cover. So, okay, so this is the idea behind this case, is to learn about all these products. So although we have certain questions in the case, we have not yet addressed those questions, okay? But the first point, the way it works is that you first read the questions in the case. You first read the case and the questions in the case, get a sense of what is required. Then you go back and read the technical notes, because that will give you the skill set to solve the questions in the case. And then you come back and solve the questions in the case. So we are in the second part of that now. We are actually going through the swaps technical note. So our priority is not so much to quickly answer the questions in the case, but really to first get a very good understanding of this product, swaps, because as I will show you, there's another book, the mistake that I found in the Hull book, which is a very well-known textbook, but there are so many mistakes, like in the first notice day case and many other statements that he has made. I think because people are not that particular about how they use the language, and they're not, maybe because they don't have they've never actually traded or anything. So maybe that gives a different perspective. So I'll just show you. So it's very important to have a good understanding of all the different product structures. All right. So, so we'll have that discussion. So I'll just, maybe we can have this thing up as well. Asset classes, markets, and instruments. When we come to that discussion. All right. So we are here now. There is a little bit of, this looks a little bit incomplete, but we will go through the note. We'll create the full layout here. Okay. Okay. We'll do it later. So right now our main objective is not so much to be in a hurry to answer the questions of the case, but really to have a very good understanding of swaps, at least of what are referred to as swaps. We may not have time to go into FX swaps, all right? So the first part of this is the industry nomenclature, which we have just discussed, that when people use the word swaps in the industry, they are usually referring to two things. generally when they refer to swaps, they're referring to all these interest rate swaps, currency swaps, commodity swaps, equity swaps. And then there's also another term called FX swaps, which are actually different from these swaps. So it's not very good terminology, but what we are going to do is, it's possible to actually, I have a better set of terms which are more theoretically correct and more consistent. But I'm not going to burden you with that because that's just my view. It is better. We don't have time for that. So it's better for me to just teach you what lingo is used in the industry, and at least you'll understand the product structures, even though it is not very, maybe not very well sort of named. The nomenclature is not very good, but I'll just make sure that you guys understand. I'll give you one example as to why I'm saying that the nomenclature is not very good, because I already told you these are two different instruments. Okay, they're very different instruments, swaps and FX swaps. So this you can call a foreign exchange swap, but you can't call it a currency swap. Okay, because those are different, because currency swaps belong here. So these are two different types of things. So it's like saying all your students are going to be boys and girls. So now you don't refer to, so these are two totally different things, like boys and girls. Now you don't now remember, notice one thing, how you have, when you do your communication in the business world, you have to be very particular about these things. Okay, we've already discussed it when discussing contracts and other kinds of stuff, and throughout my teaching I have emphasized this. Be very careful about how you're using the language and understand the meaning of words. Okay, so if I say FX swaps, now immediately they are supposed to mean, the plain interpretation of this kind of a statement would be that this would be a category of, this would be a species of swap. That's why I'm calling it FX swaps. Okay, so if I say like Bengali sweets, now if our Bengali sweets are a species of, Bengali sweets would not be samosas, right? Bengali sweets will be some species of, it's a species of sweet. Okay, so therefore that's what I'm saying, that if you use language like this, which the industry uses, I'm repeating the industry language here. Okay, so this is not correct because the products are very different. So if you say, and the moment you lock yourself into terminology like Bengali sweets, that means you're only talking about sweets. You can't talk about even other kinds of Bengali food dishes. You have to only talk about sweets, because Bengali sweets are a species of sweets. You can also have Gujarati sweets. That would also be a species of sweets. So, but they can only be sweets. So this is the type, this is the implication. If you, language has to be always used like a lawyer's use of language. That is the only acceptable use, even though you're not a lawyer, because that is how the language has to be read, because it has to have strict meanings. It should be understandable to a computer. So it's like you are referring, you have a categorization called boys and girls, and you're referring to girls as tall boys. Okay, so when you mean girls, actually you're using terminology like tall boys. Tall boys is actually a species of boys, those boys who are tall. So you can't use this kind of lingo. It's a very bad lingo, but this is how industry. So I just wanted to give you this little bit of a lecture on this point, because I want you to be aware of these intricacies. Okay, when you do your own terminology or you do your own writing, you must not make these kind of mistakes. Okay, so with that, we'll just move on to this. You have to understand what is going on in the industry. Okay, what kind of terms they're using. Right. So when we say swaps in the industry, we are talking about, and there's a footnote here which takes you to, don't include CDS as a swap. CDS is, I'm not writing the full form here because it may go on to the second line, is credit default swaps. Okay, so there's another mistake here in the Hull textbook. Somewhere, I think, at least, I don't know if it's there in the latest edition, but if they have I've seen one edition where they have, recent edition, where they have referred to as a doom put option. Doom is deep out of the money. Okay, so deep out of the money put option is basically something like this. No ads on any chart coming up. Yeah, okay. So a deep out of the money put option is a crude oil put option, where the crude oil price right now is 58. And if I look at a put option which is struck with a strike price of, let's say, even 20 is fine, if that's also good, 20, okay? So if I want to buy a 20 put, maybe let's say it's a 1 year 20 put, okay? So the expiry date is on 1 year. Now the actual underlying spot price is 58, okay, and I'm looking at a 20 strike put. Now, this would be an example. Now, deep is a subjective word. How deep is deep? Okay. Somebody might say even 30 is deep out of the money. Somebody might say, no, 30 is not deep out of the money, but 20 is. But you get the picture, right? It's very far away from the current price. So it's very deep it's very out of the money, significantly out of the money. So this is called a deep out of the money put option. Okay. So if I look at 60.50 or 60 is the price of crude oil and I'm buying a $20 put, that's an example of a deep out of the money put option. Those are referred to as, where is this note? Yeah. Those are referred to as doom put option. Doom is for deep out of the money. Okay, doom put option. You might see this in your book somewhere that they're referring to CDS, which is credit default swaps. I have referred to, I think, credit default swaps here also. Not really credit default swap, but credit derivatives. So credit default swaps actually is considered a part of credit derivatives. Okay, so I've given an example of CDS here. I can give you, maybe we can put this here and write this as CDS. I just want to make sure that you understand what CDS is. Okay, so CDS, if we put and we write a little note here. Okay. It's a particular type of instrument. Okay, so if you remember, I told you the story of singular. Okay, CDS stands for credit default swap. Okay, so if you remember, I told you the story of the London whale, JP Morgan London whale disaster, risk management disaster. They lost about $6.3 billion. JP Morgan lost. That incident where I told you that they violated the golden rule of hedging. The instrument that was involved, the market instrument combination, the instrument that was involved was the CDS. Okay, so they were doing CDSs on an index of credits. Okay, so there's a market index of credits, and they were doing it on that. But the instrument involved was a CDS. Okay, just for your thing. So what I'm saying is that although this terminology, you see once again another example of how industry uses. Oh, sorry, I was doing that there, and I did not bring it to your view. Okay, so CDS you will see in this framework under credit. Okay, credit I've not kept as a separate asset class. Many people do it. If they ask you why did you put credit as a separate asset class, you tell them that credit is under rates because every credit derivative has some underlying debt instrument that is referenced by the credit derivative. Okay, you can't have a credit derivative without an underlying debt instrument as a reference. So therefore, it is efficient to just consider this as part of this. Okay, so CDS is actually an option-like structure on credit instruments. Okay, which are again a part of the debt universe. So the point of the footnote is that when we talk about swaps, credit default swap, it uses the word swap. It is actually not a swap. It's actually an option, but it is not a doom put option as is mentioned in the Hull book. It's actually a down and in barrier option. Okay, it's very close to a down and in, not exactly a down and in barrier option. It's the closest is it's the closest instrument. The instrument that it resembles most closely is a down and in barrier option. Okay, you can read about this in the book, in my book, in that risk management solution book. What is a down and in barrier options? If you read the first part, you will find there's a discussion of barrier options, exotic options. Under exotic options, you can read it later on your own time. Okay, we don't have time to cover all these because these are quite complicated. All right, so this is just a note that when we're talking about swaps, please don't include CDS as a swap. It's actually an option, and it's closest to a down and in barrier option. It's not a doom put option, but you also learned now what is meant by a doom put option. Okay, so let's go here and try to understand swaps. We'll initially try to understand swaps. We already started yesterday, and so what we are saying here is we will have a detailed taxonomy later. So when we say swaps, we are referring to interest rate swaps, currency swaps, equity swaps, and commodity swaps. Most of the volume is in interest rate swaps and currency swaps, but you can also have, the structure is the same, okay? The basic structure is the same. And so what we have tried to cover yesterday is basically I've touched up these notes a little bit. So our second module is swaps. And then we are starting with, under that swaps, we have a sub-module called generic swap structure, okay, which is what we discussed the other day, yesterday, where you have, okay, there are counterparties, the tenor and maturity, etc. And so I've referred to the standard legal documentation terms. If you look at Business Snapshot 7.1 in your Halbasu, you will find this documentation, example of a documentation. So there's standardized legal documentation for these instruments. It's called there's the master agreement. So you sign a master agreement. It's like an umbrella agreement under which you do your deals, and then each deal has a term sheet, which you will find here. And then there's sometimes you will need a CSA, which is a credit support and annex. You don't need to worry about this, but this is basically it's a way of managing the it's called bilateral collateralization, which you would have studied in your OTC versus exchange traded market. So CSA relates to bilateral collateralization. So you can read about this on your own. Though it's not so important. These things are not so important. What is important is that there's standardized legal documentation, because there's a massive amount of volume in these transactions. So people don't have the time to separately negotiate every deal. Okay, so they just write the deal term sheet and they say, okay, it's the master agreement. They sign a master agreement, an umbrella agreement, and then it's kind of like think of it as if you understand a transaction very well. If you have a landlord who has a lot of properties and he's engaging multiple brokers to sell those properties, or maybe rent them out or something. So he has one umbrella agreement with each broker, and every deal that is done with some specific terms, but most of the legal language is in the master agreement, so they don't have to negotiate it for every deal, and that way they can do deals faster. Okay, now very important thing, very important feature of swaps, which will show you why there's a statement in Hull's book which is wrong. Okay, very important feature of swap: more than one settlement date. So what we looked at the other day, where we saw, okay, we will be covering it from here. Okay, but we can go back to the Hull book and see the swap market, but where we have, we were talking about the swap between Apple and Citigroup. Okay, right. So this, no, it's actually, we can go back further. But on the second page of that chapter, yeah, this is the one that we were talking about, right? Yeah, so this is the first example that we encountered. This is what we were talking about. Now this stuff is actually showing you here, this diagram is showing you basically what is happening on a particular settlement date, okay? But as you can see in the example here, it's 3-year swap, okay? And there are the swap is based on 6-month LIBOR, which means every 6 months there's going to be a payment, okay? There's going to be a settlement. So you'll have a total of 6 settlements here because it's a 3-year swap. Okay, it's mentioned in the text as well. So the point is here to understand that this is actually giving you one other clue into the structure, the generic swap structure, which is more than one settlement date. And this, what is shown here, is only the action or the activity on one particular settlement date. And we mentioned yesterday another feature is that there is netting. Okay, there's netting. I've not mentioned this as a feature, but I've just mentioned it as a note in terms of settlement dates. Okay, that on every settlement date there is net settlement of obligations, not gross settlement. Okay, but there is more than, so one more feature is more than one settlement date, and each settlement date is this. Okay, this stuff is happening on each settlement date. There's a net settlement happening. They look at the terms of the deal and they say, okay, this is what we have to exchange, but let's find out what the LIBOR fixing was 6 months ago. So let's find out what Citigroup owes. If it is more than 3%, then Citigroup will make the net payment to the differential payment to Apple. Otherwise, Apple will make the differential payment to Citigroup. Okay, so that's how it is settled. So the point to understand is that this is happening on every settlement date, and there is more than one settlement date. That's an important feature of a swap. Okay, basic swap structure. So you have this kind of a deal, all right. And so we have discussed all this. Okay, number of settlement dates, some jargon, which I put it here now, jargon, and these are also notes actually. So structured products. Okay, so LIBOR and arrears. Yesterday I was saying that I'd forgotten to mention it in my book, but actually I've checked it. It's there. When we discuss basis swaps, it's there. So I would have not missed it because it was it is quite a popular structure among many corporates. So I was surprised that I had missed mentioning. It's not there in the content. I think it may be in the main highlights. So you'll see that it's there in the basis under basis swaps. Okay. So we have discussed LIBOR and arrears, and you can learn about it. Okay. Is a fixed rate? This is Aman's question. Okay. Is a rate fixed or floating? All right. Now here's the statement which is not correct. Okay. Let's take this out and do it. The statement is not correct, so you should know this. Okay. Now there's a statement in Hull, which is right on the first page, I think itself. The first page of the of the chapter 7. Okay, the first page. There's a statement here that he's tried to define this. I have purposely stayed away from a definition. I'd have a definition of swaps, but it's really based on my recasting of the concepts. So I didn't want to give you that definition, but I'd rather describe a swap in terms of its key features of the generic swap structure. Now, this statement is plainly wrong. Okay, a forward contract can be viewed as a simple example of a swap. This is like me saying to you that a laddu can be seen as an example of an Indian sweet. That statement is correct, but this statement is wrong because this is what it would mean. That means a forward contract is almost a species of swap. This is not correct because these are different instruments. Okay, swaps are different instruments from forwards. These are not correct. The statement is not correct. And why is it not correct? Because let me just explain that to you. You need to understand these things. Okay. So he has to, unfortunately, I will not have the time to cover forward contracts with you. Okay. But there is a description here itself in forward contracts, and there are other places in the book where they have talked about forward contracts. So his discussion of forward contracts, mechanics of a forward contract is not wrong, but this statement is wrong actually, because they have not been very specific, particular about defining products in a clear-cut way. So forward contract has only so there'll be a little bit of a mixing of caps and title case and running hand. Okay, forward contract has only and okay. Usually most swaps will have many more than one, but if you have 2 settlement dates, that's a swap, period. You can have a 1-year swap against 6-month LIBOR. That would be called a swap. Okay. All you need is more than one. Just like we said, time series data. If I have, of course, in this time series chart, which is plotting the crude oil price over many, many periods, all I need is two data points. Okay, at least one variable. Remember the definition of time series data. At least 2 variables, at least one variable for at least 2 periods of time, which means Monday and Tuesday. If I have oil prices for Monday and Tuesday, that's a time series chart. Technically, in the eyes of a computer, that's a time series chart. The definition-wise, it satisfies the definition. But of course, in real life, nobody plots only 2 days of time series data. People want to look at this kind of data, and people like me who are obsessed with long-term trends, We like to look at very long-term data. Okay, so this is also time series data. Now, if I plot jet fuel also on top of this, that is also time series data because it is at least one variable over at least 2 periods of time. So that's just to recap, just to go back to the definition of time series data, etc. Now, a swap has, so most swaps will have, as I said, even 2 settlement dates will make it a swap technically, but usually most swaps don't have, as you can see in the example that Hal has given, that we are talking about IBM and not IBM, sorry, Citigroup and Apple having a, getting into a swap, which is like a 3-year swap, okay? And there are 6 settlement dates, okay? So, settlement dates in that swap. So this is the difference between a forward and a swap, okay? That a forward has only one settlement date. I've got to correct that, of course. A forward has only one settlement date, okay? So if you see the example of the forward that he has given, let's see what he has talked about there. Yeah, see? This, in this example of a forward, the example of the forward is not wrong, but the statement is wrong, actually. So on March 1st, company enters into a forward contract to buy 100 ounces of gold per ounce in 1 year. Okay, so it was March 2017, 1st of March 2018, 1 year forward. This is going to be the, all right, so this is the maturity date of this forward contract. Transaction date, settlement date. Okay, to see use a format for framework that you have been taught. Transaction date, settlement date. But every forward contract, there cannot be a forward contract with multiple settlement dates, period. Okay, it will never happen. Any forward contract has only one settlement date. Okay, that could be even 20 years forward. You sometimes get, in the liquid foreign exchange markets, you can get 20-year forward FX quotes. But it will be something well beyond the spot date of T+2. And it can be anywhere, basically. So 3 months to 20 years, etc. So there's only one settlement date, whereas a swap will have many such settlement dates where you will see this kind of exchange happening on each settlement date. Every settlement date, this exchange will happen. So this chart is only showing you what is happening on each settlement date. Usually this is how we describe, diagrammatically describe swaps. Okay, we are only describing the interest flows on a particular settlement date. We don't do 6 diagrams showing 6 settlement dates, okay? But it's done for only one, and then you have to read the term sheet to understand whether it is 6 months or whether it's a 3-year swap or a 5-year swap, etc. Okay, so this only shows. So therefore, this kind of a statement is not correct. It's not an example of a swap, because an example of a swap means Laddu is an example of an Indian sweet. That's not, the statement is not correct. Okay, a forward contract is a different thing from a swap. So a forward contract has one settlement date only, and a swap always has more than one settlement date. Therefore, a forward contract cannot be a swap. Okay, so this is just to show you how you should be very, very careful about the use of language. So these are things which we've already covered yesterday. Now let's look at the taxonomy for swaps. Okay, just I've repeated the statement here. So under swaps, we will talk about, and then the footnote comes again on the question of CDS. So I'll remove it here. Right. So under so basically we can write. So we can, therefore the types of swaps are all these. Okay. So just to be, therefore. So types of swaps are basically interest rate swaps. We can avoid putting numbers, but, and the reason I'm writing it like this is because this less common part I've already talked about before. Okay, so this is your swaps. These are the types of swaps. All right, so we do a taxonomy of swaps. These are all your types of swaps. As I said, these 2 are most common. Okay, that's why you notice that the book that I wrote was focused on Mainly, the instruments covered were interest rate swaps and currency swaps. Equity swaps and commodity swaps were not covered. Okay. So now, and what is this swap? This stuff now, what we are saying is, why did I call this a generic structure? You notice I'm calling it a generic swap structure. Features, a generic swap structure. All right, so this should be a subheading type taxonomy because it is falling under swaps. So it's a subheading. Let's dent it a little bit. Okay, now that is a generic swap structure which I've described here. Okay, all these features are generic swap features, swap structure, part of a feature of a generic swap structure, which means that it's generic, so it can be applied to all swaps. So if you look at an interest rate swap, a currency swap, it's an equity or commodity swap, all of them will have the structure that we have discussed mainly yesterday, okay, which is that there will be a periodic settlement every day, every settlement rate, every settlement date, there will be some kind of exchange like this, a fixed or floating, fixed, or something like that. There'll be a couple of arrows going, and there'll be two counterparties, there'll be an exchange, and there'll be certain other terms of the deal like, oh, is it a 3-year deal? Is it 5 years? Is it LIBOR? Is it SOFR? And so on and so forth. Though, by the way, I've given in the SOFR that we discussed, thanks to Utsav's very good intervention, I have put a right, I wonder where, which I think SOFR appeared in the case of basis risk or something like that. Anyway, wherever SOFR appears, I have put a hyperlink into that word, and that refers you to the Federal Reserve, New York Fed. It refers you to the New York Fed discussion on SOFR. So please only use that. Don't learn about SOFR from here and there, Investopedia, and don't go arbitrarily searching on the web. Okay. So I've given you a link for SOFR, which is a high quality and reliable information link. Okay. Where were we? Yeah. Okay. So everything that you see, so these all these will have the same kind of structure, okay? And usually we refer to it by showing this kind of a diagram. So we'll see how it works out. So let's first look at the interest rate swap taxonomy, okay? And okay, one more thing we can learn about is because we always want to learn everything based on general principles. That's why if you see, I always like to teach in that manner, because that way you can learn, you can remember things easily, and you can cover a wide range of material with some very basic general principles, okay? Fundamental principles, okay? So that's why what I did was I first showed you the generic swap structure. I discussed the swap structure, and then I'm telling you that this swap structure will apply to all of these: interest rate swaps, currency swaps, equity swaps, and commodity swaps. Now further, before we go into the detail, first we want to get a full map of the domain, okay? In the sense that when we're looking at Delhi, first we'll say, okay, there are various areas like GK2, Pitampura, Rohini, etc. I'm not telling you the details of each of those areas, but I'm first telling you that in Delhi you will find all these areas, and then maybe we'll go one by one into each of the areas and discuss a little bit more in detail. So we are mapping out the territory first. It's a high-level map out. Okay, so first is with all of these generic swap structures, the generic swap structure that we discussed can be found in all these major asset classes: interest rates, currencies, equities, and commodities, okay? Right? All these major asset classes. And when you go to credit default swap, this is bad terminology. This is actually not a swap. It's actually an option structure. This is bad terminology. That's why you notice I put it under credit, but I put it under options, okay? Although it's called a swap, it's not a swap. So anyway, so let's go to here, okay? How else can we understand? Let's have some further basic principles. Now, as you have seen, there is in the generic structure, there is a exchange happening on every the exchange that is happening on every settlement date. Now let's further try to evolve a general principle. Yeah. Let's take this one, okay? All right. Now, so the general structure applies to all four asset classes. Then further, okay, in each no, sorry, for swaps in each asset class, okay? That means all of these types of swaps, okay? We forget the English now, I'll just first write the keywords. For swaps in each asset class, what are we trying to say here? Let's look at the, yeah. We don't need to write not gross because we have already made this statement. The net settlement of contractual obligations on every settlement date is between two types of rates. Let me just see if I can save myself some work and copy from somewhere. One second, just hold, give me a second. I'm very lazy in these matters. Maybe it doesn't take much time, but I can. Basically, what I'm going to write is fixed and floating. I'm just trying to save myself the time to see if I can get it from somewhere. Okay. So this is the further framework we are going to use as a general framework. Fixed floating, okay. So fixed floating means fixed versus floating, and it's the same as floating versus fixed, okay. So which means that this is a fixed floating interest rate swap, okay, because one party is paying floating, one party is paying fixed. Apple is paying fixed and Citigroup is paying floating. So even if the flows were reversed, that Citigroup was paying fixed and Apple was paying floating, we would still call it a fixed floating US dollar IRS. IRS is interest rate swap, okay? So we will not change it. So, but of course, from Apple's point of view, you can say paying fixed or paying floating, paying fixed or receiving fixed, depending on what it is actually doing. So the flows can either be fixed floating, because we have this the generic structure, and then we are going to further put some general features and then help that to use that to understand, using a general theory, we'll understand all the types of swaps. So the net settlement, so what we're trying to say here is that for swaps in each asset class, the net settlement of contractual obligations on every settlement date is either is between, okay, fixed versus floating. Okay, so here the English is not perfect, but you know what I mean. In between, it should be different. It's either fixed versus floating, okay. Floating versus floating. And third one is fixed versus fixed. Now we have to introduce another element. See, I have failed to optimize my saving of copying, saving of writing. Okay, should have copied that. Okay, all right. So you have another thing we are going to introduce is we are going to vary this fixed versus floating, floating versus floating, fixed versus fixed. Now, against on that basic structure, generic structure, we are going to introduce one more element, okay, and that is only true of currency swaps, okay. And in the case of currency swaps, we'll introduce one more element in general, and then we'll show that it applies only to that the two currency case applies only to currency swaps. Okay, so we have a generic structure. Okay, so the market prefers to swaps, which is less common. Okay, let me also which have the common features discussed in the generic. Again, I could have copied generic. Yeah. So you know what I'm referring to. All right. For swaps, which are the net settlement of contractual is okay. So then we can make two more statements. Okay. The net settlement is either between either. So we'll make two more statements after above. We'll make two more statements. So we can call them A and B. You'll understand the scheme. I hope it's not it may be a little bit confusing now, but I will explain it to you. You'll understand. Then you'll see how easy it is to understand a wide range of instruments because we are creating a general framework. Okay, module above. Okay, so we read it like this. So we know the generic swap structure which we discussed. We know that it applies to asset class to four asset classes, to swaps in four asset classes, and the structure applies to the swaps in the four asset classes. Then we make two more statements. Okay, for these, what else is true of all of these four types of swaps? What else is true? One is that the net settlement of contractual obligations on every settlement date is either between fixed and floating, floating and floating, and fixed and fixed. And so we should put an and here. And so we can say the cash flows on either not either in this case, on the two legs of the swap are one minute. Okay, let me see here again if I can say, yeah. Where is 7.1? Okay, yeah. Yeah. Okay, so somebody is not on mute, but I don't have time to look at it right now. Please correct yourself. Okay. So try to understand the general structure. I gave you a general structure of swaps, a generic swap structure, which we are discussing the product called swaps as opposed to FX swaps. We gave you a generic structure for the swaps product. Okay, the features of which we discussed yesterday. And we showed you the diagram as well in the transaction between Citigroup and Apple.
Sir, you are on mute.
Yeah, I know. I'm just feeling a disturbance to go down. I was trying to make up for that by putting board, but good that you told me. So yeah. So you understand what I'm doing, okay? So first time, it's a general framework which will help you once you see the amount of ground you're able to cover. It will help you a lot. Okay, so you have the general features which we discussed yesterday, and in addition, we say that the flows that are happening on every settlement date, the settlement of contractual obligations, is either going to be fixed versus floating, floating versus floating, or fixed versus live. And what else can we say? What is the other general property that we can discuss? That the cash flows on the two legs of the swap are either involving either involve one currency only or two different currencies. Okay, and what are the legs of the swap? These are the legs of the swap. Okay, when we talk about the general swap structure, the generic swap structure, you have these exchanges happening on every settlement date. So we call this the two legs of the swap. So what we are saying is, so now I'll just visually summarize all that English that I've written there, but that gives you the written down the theory of the general framework, which is this kind of settlement, and along with the general features that we discussed yesterday. And this is every settlement date. There's going to be at least two settlement dates in a swap, and usually many more. And these are the legs of the swap. Okay, we call it this one. We call the fixed leg and the floating leg. So what we are saying, the two legs of the swap can vary in a few ways. They can be one fixed, one floating. It can be both floating. We'll see those examples, and they can be both fixed. And one more way they can vary is that the currencies on the two legs, either this is a dollar swap, okay? See the dollar principle, there's no mention of exchange rate. So US dollar principle and interest rates on US dollar principle. So both the flows are US dollars, but this is not necessary. You can vary this. You can have both legs. You can have both legs in the same currency, or you can have two legs in two different currencies. So you can have Swiss franc. The first swap mentioned between IBM and the World Bank, that you'll notice here. This example, they have not represented it with a diagram. Yeah, see, here's an example. The first example of a swap. World Bank had borrowings in US dollars. IBM had borrowings in Swiss francs and Deutschmarks, etc. Okay, so IBM agreed. World Bank agrees to make payments on IBM's borrowings in these European currencies, and IBM agreed to make payments in US dollars. Okay, so this is the first swap transaction. So that clearly featured two different currencies. Okay, two different currencies on the two legs. So now you see the general framework. Now we can quickly apply it. Okay, so you can either so you have a general framework, and in addition, we can make further statements, further ways to differentiate between types of swaps. We can have fixed floating, fixed versus floating, floating versus floating, fixed versus fixed. We can also have the two flows either being in one currency only or in two different currencies. And now let's see what happens. Okay, now we will quickly put everything into place. Okay, we will apply this framework. Let's apply, and no, where did we go? We have these four items. No, we have to talk about. Yeah, this is much later, but I'll wipe that out later on. This is not very well organized. Where are these? Okay, yeah. So interest rate swaps. Okay. So now, okay, next moving the thing. Okay, interest rate swaps. Then what else? Not currency swaps, but equity swaps and commodity swaps. Now these three have the same structures. Okay, equity swaps and commodity swaps. Let's see. I may make some changes here. Okay. So here you can have the subtypes are let's see. Okay, it can't be this. So these types of these three products, okay? These three products. So all three products we are describing in the same way. The subtypes are, so when you look at either interest rate swaps or equity swaps or commodity swaps, you can have three types of, the subtypes will be are basically going to be based on, the difference is what kind of rates are featured on the two legs. So net settlement is between either fixed versus floating, okay, which you saw in the case of the interest rate swap here. Okay, it's going to be either this. So here we are doing a complete taxonomy of all the swaps. Okay, once you define the general principles, then you're doing the complete taxonomy of swaps. Okay, so it's either going to have fixed or floating, fixed versus floating, or floating versus floating. Okay, there is no other typology in these three cases. Okay, so what will happen in the case of, I'll just explain briefly for equity swaps and commodity swaps. What will happen is this kind of structure. Okay, you've already seen this interest rate swap structure. Okay, and you can also have, in the case of commodity swaps, you can also have floating versus floating. Because you may take one type, you may have West Texas Intermediate on one side and West Texas and Brent crude on the other side. You can have that as well, or you can have fixed versus floating. In the case of equity swaps also, you can either pay a fixed rate or a floating rate. So we will not go into a detailed discussion of equity swaps and commodity swaps, but you can understand that for all three of these products, interest rate swaps, equity swaps, and commodity swaps, for all these products, all right, there are only going to be two subtypes. Okay, for these three products, there's going to be only two subtypes. There are only going to be products which have fixed versus floating legs and floating versus floating legs. And for these two, we are not going to discuss in detail. Now we'll go on to a discussion of interest rate swaps. So we are going to discuss fixed floating interest rate swaps and floating versus floating interest rate swaps. So I'll now do the further actual terminology, actual taxonomy for, are you guys following what I'm doing? I hope you're not getting confused. Okay. If you revise it, you'll understand it, because this is actually a very, these are very general principles, and once you understand what I'm doing, you will be able to understand a lot of, a wide range of products using these general principles. Okay, interest rate swaps, fixed versus floating. This is now for this, now we go to, we start referring to here. So interest rate swaps we start. Okay. Yeah, so this material goes into here. We have made the statement that all these three types of products will have these two subtypes only. Now we are going to have a detailed discussion on interest rate swaps, because these are not so common. Okay, so now we are saying that, let's see, what does this say? It's a little smaller. Interest rate swaps, we'll have a detailed discussion on interest rate swaps. Yeah, so we can remove this actually, because we have this general subtypes. Okay, so we'll remove this also. Now we are discussing interest rate swaps in detail. Okay, you can start with RMS by page 6. So RMS is this one. Okay, this is better. I'm using this because it's much simpler. Okay, we start from page 6, and so we have two types of interest rate swaps. There is only one currency. And briefly here we can talk about, before we hopefully we go to currency swaps. I just want to finish everything today, at least the full coverage of interest rate and currency swaps. Anyway, let's do interest rate swaps first, and then I'll come back to currencies. Or let's since we have on this page, let's do the currency swaps also here. Let's do currency swaps here. what do we have? Yeah. Now we'll make a statement about currency swaps before. All this comes under interest rate swaps. We'll make a statement about currency swaps here, like this. And we will just copy this and have a section on currency swaps. Okay. And maybe a little bit inside. Right. And, all right. So this is our part on currency swaps, and then this is our part on interest rate swaps. Okay. And so, following the RMS, we'll quickly have an overview first. So we said interest rate swaps already. We know that they are only possible. They can only have fixed versus floating or floating versus floating. What do we call them? We go to RMS page 6. All right. This is called, I'll just repeat it, a fixed rate on one leg and a floating rate on the other leg. Okay. 7.1, that is. 7.1 is now actually referring to Hull Basu. Okay. You should understand that. Okay. We can just write it here also. Refer Hull Basu figure 7.1. This is called a fixed floating. So when you have an IRS with fixed on one leg and floating on one leg, this is called a fixed floating IRS, okay? Or simply called IRS or interest rate swap, okay? People normally don't mention the fixed floating. So, or you can call it fixed floating IRS as well, okay? So this is the name given to the structure, which you already saw in 7.1, which is this structure, okay? That's your first type. So this fits the first type. Fixed versus floating. Okay. Now, what is floating versus floating in interest rate swaps? When you have, these are called interest rate basis swaps, or simply called basis swaps. Okay, but it's better to call them interest rate basis swaps because you can also have cross currency basis swaps. So we don't want to create confusion. So it's better to call it interest rate basis swaps. This swap, what will it be? This will have floating rates on both legs. So it fits in this category, okay? So this is under interest rate swaps when we discuss, okay? This is going to be called interest rate basis swap. Here I've given the name, okay? So you have two differently determined floating rates on two legs of the swap. These are these are called interest rate basis swaps. So this is called cross currency IRS sometimes. Sorry, not cross currency IRS. It is only one currency. So it is fixed floating IRS. These are the names that are given, okay? Now, there are certain other things which I've linked to here because to understand, there are some examples that I've given in the book on TED spread and all those kind of things, which you can read. So I've given you the links to those, okay? The treasury yield curve and those kind of things. So I've said that here you should stop at F8. F8 is figure 8, okay? Okay, and you can resume at figure 15. And we will omit all these LIBOR and arrears swaps, etc. Now, let me give you the quick currency swaps part of it, okay? Which is, what did we say? First, we are saying that currency swaps involve two different currencies on the legs of the swap, on the two legs of the swap. Okay, so therefore, this part, I think this part we can wipe out, okay? So the types of the subtypes under currency swaps, therefore, will be, as you can see, this is a general description of currency swaps as opposed to interest rate swaps. So the subtypes under currency swaps, as you can see, obviously will be 3. Because when you have a one currency structure, then it doesn't make sense to have fixed versus fixed because I'm paying you 7%, you're paying me 8%. What is the point of this? There is no meaning in this. There's no risk. There's no point. But if you have two different currencies, then it's a different ball game. So the subtypes under currency swaps will be 3. Okay, fixed versus floating, floating versus floating, and fixed versus fixed. On the point of this here. Okay, and it should be written like this. Right? Now let's see what these are called. This is given here. The first one is called cross-currency IRS. Okay. two currencies, two types of rates, one floating, one fixed, two different currencies. This is called a cross-currency IRS, okay, also known as circus swap, etc. Then you have a fixed currency. So there's another called fixed currency swap, which is this one. Okay, fixed rates on both sides. So fixed rate sterling versus fixed rate Swiss franc. Okay, that's another example of a currency swap where you have two different fixed rates, and then you have floating versus floating. This will be called a cross-currency basis swap. Okay, two different floating rates, two different currencies on the two legs. Okay, so these are the broad. So right now, as I said, we are doing a broad taxonomy so that you have. This is how you should study actually. Now, if we had the time, we would have gone into exact detail on each of these products. Okay, but I'll just give you a little bit of guidance as to how to study. Because anyway, you don't have to study beyond what we have discussed in the class for your exams. But you can read a little bit more, and you can actually, so in order to read this, I suggest you read from this, and you do the reading on Hull, which I've given at the top. Okay, that would be enough for you. And this is because this is easier to understand, I feel, because it's written from that perspective. There's very little use of mathematics, there are figures, etc. So you can see this. So first thing you know, two types of IRS structures and three types of currency swap structures. Two types of interest rate swap structures and two types of currency structures. So let's just briefly look at it. This you have already seen, okay, and there are some examples of hedging which I've given. Okay, so you have a guy paying, this kind of floating rate loan. There's a floating rate loan, and so this would have applied to your. If we go back to the case and try to, so this is very unsatisfactory because we are running out of time. Okay, so that's why the discussion is unsatisfactory. But as you can see here, the US dollar loan, which we have not discussed, the US dollar loan is. There's one question here, question number 5. It's a floating rate US dollar loan. How could you hedge it using USD IRS, using swaps? Okay, so that could have been answered by looking at this. This is the example of Magma Resources paying a floating rate loan. A 6-month LIBOR, but 3-month LIBOR, same thing. What they do is they put on a swap, fixed floating swap. You see how it works? At least you'll learn this much. They do a fixed floating swap with Stanshot, where they receive they pay on a fixed rate, they pay on a dollar IRS, because pay refers to the fixed rate, pay receive refers to the fixed rate. So ABC just says that we pay on a fixed rate, on a dollar IRS. What it does is, you see the 6-month LIBOR cancels out. They were paying for, they had an underlying loan, okay? So this is unhedged exposure, okay? And then you have swap in place. So you're still paying, you're not disturbing the underlying position, you're still paying your lender, but your net exposure canceled out because you paid on a dollar IRS. So you pay a fixed rate only and you receive the LIBOR. So the out LIBOR, in LIBOR cancel out, and you're left with paying 6.38. So you have converted a floating rate liability, which could be quite risky. As you saw, LIBOR moves around a lot, and you have converted it into a fixed rate. Now there is no more risk, because remember, the objective of hedging is to bring certainty to cash flows. So now to go back quickly to Srishti's question about the risk of these kinds of transactions, okay? Should he do the swap? The answer is actually no, because from a classical hedging perspective, no, because right now you have no uncertainty. You're paying 5%. If you swap into floating, you will end up with a floating rate exposure, and that could actually end up going quite dramatically higher. So therefore, from a classical hedging perspective, you should not, because right now you have no risk. You have currency risk, but you don't have interest rate risk, because the interest rate is fixed. Okay, there's a point that Srishti was hinting at, that if they swap into floating, then everybody will do it. But as you can see, floating rates do fly around. So therefore, it's not such a simple thing, especially if you have a long-term swap. You swap into floating and you could end up losing a lot of money, all right? So there is some alarm that has gone off. For some reason, there was no sound. Okay. All right. Okay. So that's fine. So we are basically, your syllabus is what we have, whatever we have discussed. So it's only the high level discussion of swaps. But for your own understanding, to cement this understanding, I suggest you go through the RMS. The guide is given to you here. I'll just take a couple of minutes to wrap it up. Okay. So the guide is given to you here, that you stop at F8, after F8, figure 8. Then you resume at figure 15. Okay, see how swaps are coded, and then the discussion of currency swaps. You'll understand. But hopefully this overall framework helps you to understand things, because you have a generic structure and then you have certain variations. Okay, so you have certain variations, like I say that, okay, all students, they can only wear blue, yellow, or green jerseys. And so you can classify like that. And then you say additionally that all students, they can, either only wear, whatever. Maybe they can either have pizza for lunch, or they can have pasta for lunch. In that way, you can further classify. So this is how we have done it, and general principles. And using these basic general rules of the variations, you can actually cover all the types of structures, both currency and interest rate. All right, somebody sent me a message in the chat. Okay, can you hear me now? Is it better?
Yes, sir.
Okay. I don't know why. Maybe I moved my face away a little bit from the computer. Okay, guys, so this is it. Now you are done. The class is dismissed, because I don't want to hold you up. So anybody who has a conceptual question can ask, and then we'll stop the recording. And then what will happen in terms of your administration is, once I get a heads up once I get an okay from Ketan and Varun and Vipul, they're supposed to monitor their interest accounts and regularly, every few hours, and immediately inform me when they're ready to trade. And then I will give the green signal to everybody, and then you follow what the instructions are, and then I'll give you instructions that about 5 days before the closing. I'll send you the reporting format and what you have to do, but you understand what is going to happen. Okay, so class is dismissed. So anybody has any conceptual question at this stage?
Thank you, sir.
Yeah, welcome. Okay, so yeah, this is your last class, so don't worry about, as I said, don't worry about attendance and all that. Shubham and Raghav were very worried, so don't worry about that. Okay, so now the only thing I will say is, so that's, I think I probably won't be teaching you guys anymore, but you can always call me later on for anything, any clarifications, even when you join industry and all that. So good luck, and I'll have the only chance to wish you guys, good luck with your placements and career and all that. And you can always call in for any kind of inputs that you need. Okay, so we don't have to. That door is always open. So you just have to call or email or whatever. Okay, take care, guys. Everybody, good luck. Bye.
Thank you so much.
Thank you so much, sir. Thank you so much, sir.
Welcome.
Thank you, sir.
Thank you, sir.
Okay. Any question? Any conceptual question at this stage? Okay, nothing. Okay, so we have some tutorial sessions also. I'll check the spreadsheet. We had some tutorial sessions also with somebody, I think. Vipul and Sachin, I think we have something lined up. So we'll do that according to or maybe Vipul, do you want to, I'll stop the recording.